How can average working citizens like us, how can we reform our unjust financial system to erode the wealth and power of big banks, traditional corporations, and the super rich, and redistribute that wealth and power to average working citizens without relying on politicians or regulations? This is the question we ask on the Crowd Effect podcast. I am your host, Paul Lovejoy, activist, investment advisor, and founder of Stakeholder Enterprise. On today's show, we are going to continue our discussion on democratic vehicles of change. Specifically, the vehicle of change that I will be talking about is crowd lending. But first off, let's talk about banks, traditional banks. And the services that they do provide. Banks are a wonderful, safe place to keep money. They are FDIC insured, meaning that up to $100,000, the United States government will guarantee that your money will be safe there. And that's huge, especially back prior to the Great Depression, where that did not exist, and people lost all of their savings. Well, that's no longer the case anymore. Um, Another thing that banks do, traditional banks, they provide checking accounts on top of savings accounts, which also provide incredible convenience for people. Um, it's convenient to store your place, to store your money in a place where you can link certain bills for auto pay. You can also access ATM machines, especially with the big banks, the major banks, the four major banks. They have ATMs all over the place, all over the country, and it makes it incredibly convenient. They also they have a lot of money, so their websites are very convenient to use. It's easy to apply for loans, um, lines of credit, and these are just some of the things that big banks provide people. They also have spending reports on their websites and helpful things to if you have a small business. It's helpful to collect information on your own expenses. And so, yeah, those are some of the things that traditional banks offer. I just mentioned the four major banks. These four banks hold half of all of banking assets in the United States today. The number one bank, which has the most banking assets, is Chase. I'm sure you're familiar with that. The what rounding off the top four is Bank of America, Wells Fargo, and Citigroup. Now, I mentioned some of the good things they do, but there is a cost to this. First of all, the sheer number of violations that these four banks alone um, have caused is staggering. So I have some figures here. So the top three banking violations, according to the violation tracker, which tracks. It's a really awesome website if you're interested in tracking corporate violations. And they've been keeping track since 2000, really since records have been digitized. So these are as of 2000, the violations that they've found. So the top three banking violations are toxic investments, toxic securities, another way of saying investments, um, investor protection violations. So they are exploiting the investors that are going on to their platforms. They're exploiting them. They're violating the investor protections. And then you're just run of the mill banking violations, overcharging fees. Wells Fargo had that huge settlement just a couple of years ago with all the fees, these excessive fees that they were charging, really weren't even telling clients. They're also um, uh, going behind their clients' back and setting up other bank accounts for them when they didn't ask for it so they can charge more fees. There's all this kind of crazy stuff. But yeah, banking violations. So the top four banks with their toxic security abuse, they've had almost $50 billion in penalties since 2000. 35 violations. The of the top four. We can break it down further. Chase has seven, Bank of America has 11, Wells Fargo has seven, and Citigroup has 10. Um, wow. Investor protection violations. Um, $30 billion in penalties since 2000. 30 billion. 75 violations for Chase, 115 for Bank of America, 82 for Wells Fargo, and 66 for Citigroup. Banking violations, you're just run of the mill banking violations. $14.6 billion in banking violations of the big four. 14 of those were committed by Chase, 14 committed by Bank of America, 17 for Wells Fargo, and 13 for Citigroup. Um, Now, these four major banks, um, they they do loan a tremendous amount of money that stimulates the U.S. economy, that makes it grow. However, um, anytime a bank issues a loan, they are creating money. This is how the vast majority, some estimates as high as 97% of all money is created this way, with these traditional banks issuing loans. Now they're able to issue loans based on the deposits of account holders like you and me. So we put our money into Chase, let's say, and let's say we have $5,000 in Chase. Now, if Chase issues a loan for $5,000, it doesn't come out of our bank account. Our bank account doesn't go up and down based on the loans that Chase is issuing. But Chase can't issue the amount of loans unless there's account holders is depositing money on there. So if Chase has $100 billion worth of and I'm not sure if they do or not. I'm making that number up. They probably have a lot more, uh, uh, in the trillions, I would imagine. Uh, let's say that they have, well, maybe not. I know that the four that Americans have a combined $1.75 trillion in all in banks, in savings and checkings. That doesn't include small business accounts, though, or institutional, large business accounts. That just personal savings. So I imagine that if you include uh, business accounts and institutional accounts, we're talking trillions of dollars. Um, Probably not that hard to find out. So let's say Chase has $100 billion that account holders have deposits in. Now, Chase, they can, through something called fractional reserve lending, they can loan out um, based on a percentage that the federal government allows. So they say, okay, you can loan out um, 90% of what of account holder deposits. So if it's $100 billion, then they can legally loan out 90 billion, and that 90 billion will be created. It's that this is how money is created through these loans that commercial banks offer. But that the today the federal government is 0%. So uh, banks like Chase can loan out 100% of the amount of deposits that account holders have. So if it's 100 billion today, they're allowed to loan $100 billion. Imagine if you or I could do that. Like, hey, I've got 5 grand in the bank. I'll loan you 5 grand, but I don't actually have to put up my 5 grand for it. It's pretty wild if you think about it. So these banks are doing that, and some money creation is vital for our economy. This is how the economy grows, GDPs grows, and you're not keeping the pie the same size where everyone's fighting for a slice of the pie. Instead, the pie is always getting larger with money creation, and that way it gives an opportunity for other people to get a slice. Um, Unfortunately, that's not the case. The rich are getting richer, um, and it's our pie is expanding, but the share for just average working citizens is not increasing, and that's a problem, and largely because these commercial banks are loaning to exploitive companies and projects. They're exploiting their own customers, as I just mentioned, with the toxic securities, the investment protection violations. Um, so they're exploiting their customers. Um, they're funding exploitive companies, projects, and all of which are businesses that aren't including all stakeholders. Um, Again, a stakeholder is anyone who has interest in the success of a business. So it can be customers, employees, vendors, suppliers, the community the company serves, shareholders and investors, the environment. Those are all stakeholders, and um, these banks aren't investing in projects that have all stakeholders that have a responsibility to all stakeholders. Instead, it's just a responsibility to just one stakeholder, really, investors and shareholders. So, because of this, just a single focus of responsibility, um, the rich are getting richer. That this is how it, and the money pie is growing bigger, but the working average working people aren't getting their share isn't growing. So yeah, this is a problem, a huge problem, right? Rich are getting richer. The banks are abusing their customers, and it publicly. I mean, it's not. This isn't hidden. This is really easy to find this information. Um, and yeah, they have great marketing. Gosh, big banks are so convenient to use. I get it. I do bank with a credit union. My business is banking with a credit union. Same with my personal account. But I do have a Chase credit card, business credit card. It just the convenience of it. You know, I know that's hypocritical of me to be saying that, and but at we're all kind of almost a slave to this system until there's better options. I couldn't survive without my Chase card. Sad as it is to say, that is the truth. So, what are we going to do about it? I want to do something different. not have a Chase card? Well, this is where crowd lending comes in. So we put our money into these banks, and the banks instead they go out and because that we put our money in, they're allowed to loan money and create it. And for for us putting money into their bank, they give us just horrible interest rates for our savings accounts. We're talking, if you're lucky, 1%. It's nuts. It's crazy. And what are they doing? They're making double digit returns off of our money. So this is why I love crowd lending. This is why it's a vehicle of change, because you, instead of putting your money into a exploitive bank, you are loaning directly to people and projects you care about. You have now the power to loan money to a small business. You have the power to loan, to make a personal loan, to to finance a real estate project that improves the community. Um, and so that's just one aspect of it. Uh, the other aspect is that now the average working citizen can get increase their share of the pie of this money supply. Um, and on top of that, the because of the low minimum requirements for crowd lending, we're talking $10. Some of them now they've lowered it, and it's $1. You could get involved in crowd lending with $1 to loan. And but there is a drawback. With a savings account, you can take your money out whenever you want. Well, crowd lending, there are ways where you're constantly getting the loans repaid, and you can set it up in a way where you're getting new streams of income. So, and that's where an investment advisory firm is super helpful, such as Stakeholder Enterprise, because this is what we specialize in. We specialize in crowd investing and having a plan for average working citizens to put their money into crowd lending, skipping not by and skipping the big banks. The big banks, you're not um, you're not fueling this system of greed. Instead, you're loaning directly to other people. It's a peer-to-peer approach. And a lot of crowd lending is called peer-to-peer lending. So crowd lending has the opportunity for the average working citizen to grow their share of the money supply pie. It has the opportunity to um, reverse income inequality by by funding companies and projects and people that promote the well-being of each other and our planet's finite resources. And also, um, by crowd lending, uh, you're also slowing down this inflation too, because there is too much money supply every year. That's why inflation happens. There's a standard looks like 2 to 3% is kind of typical. I know recently we're at 8, 9%, which is even nuts. Um, but this money supply, there isn't that balance right now. And with more people, instead of putting their money into bank accounts, which these commercial banks will loan out, instead you're putting your money and you're loaning it directly to someone, and we're not creating any money that way. So it's a way to stem inflation as well. So I mean, what an incredible vehicle of change we're talking about. Um, uh, uh, Stemming inflation, reducing income inequality, uh, preventing toxic security abuses and investor protection violations, um, giving average working people an opportunity to increase their own wealth. And it's a way for not the rich to get richer, but the people to get richer, and a way we can all equally share on this increasing pie of money. So, gosh, I just really love the crowd lending and talking about it. It just makes me feel good. It makes me feel hopeful that there is a future where we can increase the wealth of the masses without confrontation. There's no need for any laws or politicians to do anything. There's no one going to stop you from becoming a crowd lender. Um, and so it's just this frictionless way, and on top of that, crowd lending can be automated. You don't even have to be manually doing it. It's diversified. You can get bank level diversification with crowd lending because of these low minimum investment requirements. Um, it it it's a low cost of entry, so just about anybody, everyone has a dollar. If you have a bank account and a dollar, you can become a crowd lender. So the entry to barrier the barriers to entry is virtually non-existent, and I offering a community where we can support one another to make crowd lending a go-to vehicle of change in reforming our unjust financial system. My name is Paul Lovejoy. I am a crowd investor, and I see you are one too. If you want to learn how to reform our unjust financial system democratically without protesting or divisive political action, go to stakeholderenterprise.com.